what about the market and the mood overall? We do have Naresh Miraini joining us on the show to talk to us about just that. And, Dipan is also with us. Just wanted to start by asking you, Naresh, as to what the market mood is looking like, because that last hour of volatility is something which is in focus right now.
Markets, Nifty has given up the 200-250 pointer uptick, and we are barely up 50 points as such. Same is the case with Bank Nifty, which was almost up 800,000 points at peak, has given away that lead. But if you look at the small cap and the mid cap indices, they have not come back a bit. So it continues to be an indication that the selling pressure from the FIIs continue. There is pressure in the heavyweights. We are not able to see a sustained pullback in a HDFC Bank or a Reliance Industries, which continue to hit day lows as of now. So for now, we are just consolidating, trying to form a base here on the index, but the recovery is decent. The breadth is decent as such. So if you look at the breadth, it is much better than what it looks on the index as such.
Mehta joins us now. Dipan, there were two concerns in the market on Monday. One, China, second, Middle East. Both those concerns have gone on the back burner. Yet markets are not responding to it. So the reason of fall was FII was selling. They were taking money to China. China started falling. Second concern was crude is going higher because of tensions in Middle East. That also seems to be getting addressed. So can one safely say that for the market, the concerns which bogged us down, they are behind us now?
Yeah, Nikunj, good afternoon and thank you for having me on your show. Well, that's nice and simply put. But the overall issue about overvaluation and the amount of paper coming in the market, promoters selling, all of these don't get resolved with a 4-5% type of a correction. And markets do not need the reasons can come afterwards also. Sometimes a particular event may act as a trigger, but then the concerns may come through. And I suspect that this quarter season may not be as exciting. Even last quarter we were a bit disappointed, but this one may not be as good at all. Because a lot of industries are struggling, right from cement, automobiles, and that auto ancillary, and even software services. So there are many challenges in many industries, and we should brace ourselves for slightly tepid growth in terms of the quarterly numbers, and that may be playing out in the markets from now, where people are maybe lightening their positions.
So that's the latest coming in as far as the market mood. That overvaluation and earnings cycle is something that we'll have to watch out for. But Dipan, what's the view on Pharma, and specifically if you track Divis, because that one is up around 8% right now?
Last 2-3 quarters, Divis results have been exceptionally good, and they had an issue with in terms of the contract manufacturing. Those contracts and those orders were not shaping up well. But last 2-3 quarters, we have seen very good order position, new molecules coming into play, and the company seems to have got its rhythm back as well. So I'm very positive on Divis Laboratories, but valuations have been on the higher side because it's been a quality performer. But maybe Pharma across the board may really surprise us in this quarter. And from a quarterly trade, like a short-term trade, I would be overweight Pharma on a trading position basis.
Okay, here's a comment from RBI governor on where the RBI's monitoring machine is focusing on NBFCs, and why they feel that for NBFCs, it really could be more about self-realization and risk management when it comes to the future course of action.
We don't treat banks and NBFCs or any other financial institutions as adversaries. We work closely with them in a spirit of cooperation, and as I have said in my statement, we always expect self-correction, and we give enough time to whether it's a bank or an NBFC, to take necessary corrective measures at their end. We encourage them to do that. So it's not an adversarial relationship, but as a regulator and supervisor of the financial system of the country, it's our duty to point out where we see possible or potential risks becoming more serious and advise them to take corrective actions.
And have NBFC stocks reversed after that? Let's mark some of those NBFC stocks, especially the ones which are largely in the unsecured loan category. That would include, let's say, a 5-star, for example, very large unsecured book. That would include some of the microfinance companies. So let's take the conversation forward with Shweta Daptardar, Vice President and Lead Analyst, Diversified Financials with Elara Capital. Shweta, is RBI in a sense giving more like a profit warning or more like a, it is more like a big brother warning for NBFCs that you have to slow down, otherwise we will come after you. Can one look at RBI's comments in with this kind of an assessment?
Yes, definitely. Good afternoon. So the strong words are coming from RBI, and this is more so because RBI is sensing that the credit expansion that has happened, especially in the MFI, MSME space, which has happened like over past several years, now it's leading to balance sheet risk because most of these financiers have been chasing growth while compromising on credit quality. So further, RBI also highlighted that the retail growth has exceeded retail demand, which has primarily led to indebtedness in the system. So that's where largely the apprehensions are emanating from.
So do you see that the unsecured focused NBFCs, especially the ones in the microfinance business or in the entire personal finance space, could get derated?
Yeah, so we're seeing that for a while now. So while RBI had highlighted several months ago the unsecured portion and the top-up loan exposures, as well as the usurious rates which MFIs have been charging, so definitely they have called out risk on these business segments, primarily from the perspective that one, like I mentioned, indebtedness at the borrower level, two, the excessive credit expansion, defying the defying the data on labor, defying the data on increased incomes at the rural base. So despite this remaining steady, there has been disproportionate increase in ticket sizes, especially in MFI and MSME unsecured category. So that is where primarily the concerns are coming. And as you rightly pointed out, going forward, NBFCs will have to see recalibration of growth rates. There will be recalibration even on the risk pricing rates front as well. Perhaps we might see some review in guidelines coming from RBI in near future, say in terms of how the risk pricing, credit risk management should happen.
All right, Shweta. Really appreciate your time. Thank you for joining us. Dipan Mehta, should we take that point forward, which is that where are NBFCs headed? RBI clearly seems to be indicating that, look, NBFCs are growing at a rate which is much higher than the industry average. They are depending a lot on bank credit, which should have not been done. And they've got NIMs which are higher where risk is getting compromised. And I've seen that when Reserve Bank of India makes a policy statement, it tends to have an impact on the sector for a long period of time. Do you think NBFCs could run the risk of underperforming now?
No, I think that the concerns of RBI are not new. And it's very evident that NBFCs generally have been growing higher. Their NIMs have been higher, but also at the same time, their credit costs have been higher. I mean, look at the way the credit costs were there in the microfinance NBFCs and even the gold loan NBFCs. So that's the business of the NBFC, that they lend to retail, they take the risk, and they deliberately have higher NIMs to account for higher NPAs which may take place. And that's true even in some of the housing loans also, which they extend. But end of the day, the NBFCs play a very critical role in delivering credit to the last mile, especially the underserved. And their systems of assigning risk weightages and collection are exceptionally good as compared to the banks. So NBFCs, I think their market share will keep on growing. Of course, they will keep on having issues, and RBI will try and regulate them better and better. But I don't think that just because RBI statement, because of that, one should get underweight NBFCs per se. On the longer term basis, I think NBFCs will outperform banks over the next 2-3 quarters, 2-3 years as well. So we are not letting go of our overweight position. And some large NBFCs like say Bajaj Finance, Bajaj Housing for that matter, New Listing, L&T Finance, they all lend very, very responsibly. And some of the new also NBFCs, the housing finance companies also like Aadhar Housing is there and Home First, all are responsible lenders. and adequately covered. So I don't think that we need to be worried about NBFCs. There'll be ups and downs in terms of their NPAs, but by and large, these are good growth stories.
Taken. So that's the view coming in on NBFC financials and what RBI is saying around that. For the markets right now, you have REITs, which is doing well. CDSL has perked up. Remember that NSDL IPO got approval from SEBI at least just this week itself, if I have it right. So there is some sort of optimism there. GIC, Phoenix Mills, Blue Star, Torrent Power, Escorts, these are some of your other big gainers. We'll slip into a very short break, but don't go anywhere. We'll be right back with more.
Thanks for staying with us. 45 minutes of trade left. Markets have given away all the early gains. 1 day of comeback, and are we back to that downward spiral? Depends. So what is the right way to really judge that this market is nearing its downward or its downward grind?
It's a very nice question, and I've been also thinking about it for a long time. And if you look at it, and we can take the help of technical analysts also, there's this, lower tops and lower bottoms. And once that gets established, then we can be sure that this leg of the bull market is over, and we should expect the market to drift lower and lower, and we could have a serious correction by serious 10% plus type of a correction on our hands. Because if you look back at the last, I think, 2-3 years or so, there has hardly been any phase where we have seen this phenomena of lower tops and lower bottoms. And that needs to get established, because every time a bottom gets created, 4-5% correction is there. Within a few weeks, the market scales to a new high and the lost ground is covered. And this time around, one needs to see whether the same pattern is being repeated, or it tries to go up and not able to create a new high, and then suddenly it slides from there. And that will lead us to believe that, yes, this phase is over, and markets can drift lower and lower, and you could have a more severe correction. So I know that this is it's not a fundamental answer, but having watched market for last 30 years or so, this is one pattern I look out for to ascertain whether the particular phase of a bull market is over or not.
Suresh, if you would like to just perhaps take that point slightly further.
Technically, if you look at it, what Dipan explained is what we generally look out for, an indication of a trend change. Now, how would we look at the markets currently? 24,750 was the low in September, which was barely a 5-day downtick, swing low. Then going back in August, the low was around 23,500 to 23,000, rather 23,900 to 24,000. Now that's a price point. These two price points are the important swing lows. So the first indications of a momentum getting punctured is if we start sustaining below 24,700, and only below 24,000, 23,800 is where we say, okay, the trend has now shifted and every bounce back will continue to face selling pressure. So for now, the previous top is 26,250. Out here, we are still in the first 7-8 days of a correction, barely 6-7% down. In this case, too early to say, but also we need to realize when we go in through such phases, there are opportunities unless it's a major cyclical top. So if you go back to 2021, the index topped and did not come back for the next 12 to 24 months to the same prices. But in that period, there was a huge rotation. We went from digitization, pharma towards old economy, manufacturing, PSU, etc. So the only time you start worrying about the markets when you think it's a parabolic top does not look like, because we've not seen a major move happen in a very short period of time. It's been a slow and steady uptrend. So out here, my view is if we start breaking 24,700, we take the view that we might get into a new rotation and have to be careful about stocks which have already rallied a lot, and that we have already started seeing in railways, defense, etc. The bounce backs are getting feeble in them.
Point taken. So 24,700 is that line in the sand that we should watch out for. Shrikant Chauhan also joining us on the show right now. Shrikant, talk to me about a couple of these big buzzers. Exide, for instance, is up almost 5% in the trading session right now. And the other one that we are watching out for is Torrent Power. Good amount of bounce back there.
Yeah. Good afternoon, everyone. See, for Exide Industries, if we see the daily or weekly or monthly pattern, all are indicating us that the overall stock is into strong momentum. And after correcting to the extreme levels of 450, 440, now again the stock is recovering. So while looking at its long-term pattern, and then if we consider the correction of last few weeks or few months, I am of the view that the stock is again ready to move towards the levels of at least 580 or 600 levels. So if there are any investments, or if someone is really interested in buying and holding this stock for next, let's say, a couple of months, then certainly at these levels also one should look for adding this stock, because the overall momentum is still intact, and the stock is now again, after consolidating at lower levels, it is rebounding back to the its previous highs. So it's a buy even at current levels based on technicals. The other stock on which you asked is Torrent Power, and there also the overall relative performance of the stock is much better than other stocks in the same basket. Whenever there is some lull period in the market or correction, we see some sideways sort of activity, but whenever there is a recovery, it crosses its previous high. It means that there is specific buying interest and sellers are not that active. Based on its technical formation and based on a few extensions and retracement based on which we can find out the next targets, I think the stock is heading for the levels of 2200 or 2250. So here also at these levels, it is not advisable to buy, but yes, if there is any correction, then close to 1800 levels or 1750 levels, certainly we should look for taking some long bets or contra bets in this particular stock.
All right, now where is China headed? Everybody's trying to just figure this out. Is it headed towards recovery, or this is more like a deep swell, like we say in market parlance, more like a dead cat bounce or flash in the pan? There are some experts who've got a very strong opinion and understanding of where the Chinese economy is headed and will head.
China's move is actually going to help India, because more and more investors will be forced to buy emerging markets index. And that means India, not only China, but India. So India looks like it's in pretty good shape. We'll be favoring India and Taiwan. Of course, Taiwan benefits from an upturn in China because there's a lot of trade between Taiwan and China. Going forward in our portfolios, India will still be much bigger than China. Of course, we continue to look at China. We've looked at China even before this upturn, but we find that there are more bargains, more opportunities in India at this stage.
India has been very strong. It's been making all-time highs, which is great for India. In my view, for the first time in my investing career, New Delhi wants people to succeed and they want people to make money. That is great for India, and it's a major change. So in my view, India is a good place to invest now. I sold too soon. If it goes down, I hope to buy back. I still have my Chinese shares. I have not sold any Chinese shares, and I continue to look for more. It may be too late now, but China's market is still depressed compared to most world stock markets.
If I look at China versus India, let's talk about scenario. If I look at for, let's say, a few decadal perspective, I think it's India decade. But even if I look at from longer term perspective, I think people have burned their hands badly in China. I think in long term, money will not shift. Now, question comes from the near term and the medium term perspective. Yes, the market has beaten down significantly. The first time they have showcased that they care actually about the market. So money has shifted, and money can shift even in the near-term perspective.
In portfolio investors going to allocate out of India to China. And at the same time, they'll have to keep in mind that now with both the engine firing in MSCI Emerging Market Index, which is China and India, almost contributing little under half of the index, will more flow come to MSCI Emerging Market Index? And if it is a passive flow, then some of it will come to India. So one factor to watch out will be flows from the foreign institutional investors. And the second thing obviously will be earnings.
Okay. Dipan, there are two ways to look at things. China comes back, what happens? China does not come back, what happens? If China comes back, it has to be backed with growth. It has to be backed with real recovery in the world. If the second largest economy in the world is making a comeback, then it is backed by growth. It is backed by rally in metals. It is backed by some fundamental changes which will happen. So one has to really assume that, okay, China is back and the trade is back. What should one buy? Because if a large economy is making a comeback, that is certainly not bad news for equity market.
Yeah, Nikunj, you're right. It's not bad news, but there are structural changes taking place within the Chinese economy, and any steps or incentives given by the government is not going to translate into a higher demand for steel and aluminum and metals and stuff like that. I mean, there's a surplus of capacity over there. So just because China's growth starting to move up, I wouldn't buy metals. Anyway, I'm very bearish on metals per se, have been so highly volatile in terms of earnings. So just on that count, I wouldn't be overweight on metals or any other commodities for that matter. And trying to focus on China and Iran and Israel and Ukraine, that is taking away the main central focus, which is trying to find good quality stocks at reasonable valuations in our markets, which there are very few. So, one has to wait for a correction, and the correction may not be completely even. Or you may have uneven corrections. Certain sectors may correct more than the other sectors while others are rallying. So one is to have a focus on those kind of sectors where we have seen a deep correction and where there are good quality stocks, which may come at reasonable valuations. Like look at defense stocks. I think there's a correction of 25-30% over there. Who knows, the 10-15% correction, and they may look extremely attractive because they have a multi-year order booking position in place, and defense spends are not going to go down anywhere in the near term. So these are the kind of situations that we are looking out for, where sectors or companies which have got terribly overvalued, and there's a correction of 25, 30, 40% or so, and 2-3 good quarters also come through, which means earnings go up, and we see a compression in the PE multiple. Those are the things we need to focus on more. I think at this point of time, it's better to have a bottom-up approach rather than a top-down approach.
Market to look at the bottom-up approach and not really top-down. Dipan, on that note, we let you go. Thanks so much for making time for us today. But let's take some closing trades ideas from our technical experts right now. Naresh, you go first.
So Pharma, the sector has been doing well, and that is where we are seeing good momentum. And Cipla has been a slow and steady uptrend. Today also the stock has hit a fresh 52-week high and an all-time high. So taking it as a very quick trade with a stop loss at 1670.
Shrikant, what about you? Is that Pharma for you which is doing the trick, or some other sector?
Yeah, today we are seeing some activity in auto companies. In fact, since last 2-3 days, if you see the buying attraction, then there is a specific buying interest in stocks like Mahindra & Mahindra, Maruti, as well as Tata Motors. But in that space, we like Mahindra & Mahindra. While looking at its technical pattern, today the stock has rejected to cross its all-time highest level of 3225. But based on its overall technical pattern, I am of the view that the stock is ready to surpass this level. And after surpassing, we could see the levels of 3500. So Mahindra & Mahindra looks attractive at current levels around 3162, 3165, with a stop loss at 3100 on the downside. On the higher side, again, we can expect 3400 and 3500.
Reliance, because when I just last saw Reliance, it is again down and leading the market decline, almost at the lowest point of the day. And this is on back of about a 7-8% rally cut, which has already come for Reliance. So 33, 3400, I'll just check the data. Was it 32, 33? I'll look at the data. But yeah, it's down 6.5%, 7% actually from the high. Naresh, is this trend now translating into a serious downward spiral for Reliance? Because last week we checked, Reliance had already gone below the 200 DMA.
So it's been under pressure, and we've seen the heavyweights are one which are under pressure in the index. So if you look at HDFC Bank under pressure, you have Reliance under pressure, you have ICICI Bank under pressure. So this whole place has been under pressure, and Reliance has actually given up all the gains from the lows of the election day. That day the stock middle of 2730. Last we had seen 2700 prices was back in Jan of this year. So the stock has gone nowhere for the last 10 months now. So out here, I would expect a lot of support around that 2700 mark, which is a major support. So could be in the process of finding a base. And if it starts breaking below 2700, that's the time we say the trend has been punctured. So for now, it's a trade wherein buy closer to 2700, keep a 50-pointer stop loss.
Okay, so that's the latest on Reliance. Yes, materially off the highest point, not only of the day, but the 52-week high, which is around 3,200 bucks a piece. Overall, the market itself has taken a bit of a tumble, and in fact, in the last couple of minutes, it has been a sharpish kind of fall. and the Nifty now down almost 250 points from the highest point of the day. Last 30 minutes of the trading session left, and it promises to be another volatile ride. We'll take you through that on the other side of this very short break.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits, and then break right through them. Become something more. It's my time to rise.